The trade gap has widened for the Philippines. Exports in July remained flat, even as imports grew by 30%. That's the fastest this year. To know what these latest numbers mean for our economy, we have the research head of BusinessWorld, Leo Uy, live at the BusinessWorld newsroom in Quezon City. Leo, first, where are we with the trade figures for July, and which items drove the growth in imports and exports?
Well, Robbie, the export growth in July was at 0.3% annually, which really isn't that much. Although analysts have said that this may indicate a recovery in the sector, as this marked the second straight month of increase for so far this year. Please note that prior to that, exports were down for 5 straight months. For July at least, we saw a mixed turnout on the major export items, such as agro-based products and manufactured goods contracting during the period. The silver lining for this report is that electronic products, which make up 56% of the total exports, went up 5%, and which has been a trend for so far this year. Meanwhile, imports grew by 31.6% during the period, which is the fastest so far. We continue to see broad-based growth in imports with all the 3 major items. You have capital goods, raw materials, and consumer goods growing by double digits.
Okay. You've been speaking with analysts. We know what explains these movements.
Well, from the export side, we're seeing higher base effects, according to the analysts that we talked to. They're saying that due to the high showing from last year, the growth rates that we're seeing right now pales in comparison. For instance, the 0.3% growth in exports is small compared to the 21% growth in July 2017. Also, the subdued external demand and the business sentiment played a role in the low export turnout, which is partly attributed to the ongoing US-China trade war. If you recall, US President Donald Trump is considering a tariff on the $200 billion worth of Chinese goods, which is on top of the $50 billion worth of goods that was imposed earlier. Since then, the Chinese government has responded in kind with an equivalent amount of tariffs towards US goods. The high import growth, meanwhile, suggests that domestic demand continues to be strong, shown by the import of capital goods and raw materials.
Okay, now on a related front, the peso is weak. What does this mean for either imports or exports?
Well, the continued weakening of the peso relative to the dollar certainly puts pressure on the country's current account, in which this will increase the cost of our imports. Since analysts do not really expect import growth to slow down this year, we could expect the worsening of the current account balance in the months moving forward. However, according to the reports, this may not really be a cause of worry, as the level of the current account trade deficit is relatively small. And considering that the purchase of imports is being put to productive use, and this is not going to be a cause for worry, at least in the next 12 months.
Okay, that was BusinessWorld's Head of Research, Leo Uy, live from Quezon City.